A Random Walk Down Wall Street by Burton Malkiel, a WealthWorks summary. Introduction, A Random Walk Down Wall Street. In 1973, Burton Malkiel, a Princeton economist and former member of the Council of Economic Advisors, published a book that challenged almost everything the investment industry believed about itself. A Random Walk Down Wall Street argued that stock prices are essentially random in the short term, that technical analysis is worthless, that most fundamental analysis produces no lasting advantage, and that a blindfolded monkey throwing darts at a stock list could match the performance of the average professional fund manager. The investment industry was not pleased. 50 years later, the evidence has largely proven Malkiel right. A Random Walk Down Wall Street is the most academically rigorous book in this series. It draws on decades of financial research, the efficient market hypothesis, behavioral finance, modern portfolio theory, and translates it into advice that any investor can act on. The conclusion is the same as Bogle's and Collins, arrived at through a different route. Own the market through low-cost index funds, diversify broadly, and stop trying to beat a market that processes information faster and more efficiently than any individual can. Chapter 1. The Concept of the Random Walk. Why Prices are Unpredictable. The random walk hypothesis states that stock price changes are independent of each other, that knowing yesterday's price gives you no useful information about tomorrow's price. Past price patterns, however convincing they appear in hindsight, have no predictive power about future movements. Malkiel supports this with decades of empirical data. He shows that professional chartists, technical analysts who study historical price patterns, perform no better than chance when their recommendations are tested rigorously. The patterns they identify are real in the past but have no predictive power for the future. This does not mean that all information is irrelevant. It means that all publicly available information is already reflected in stock prices. The market processes information with extraordinary speed and efficiency. By the time you read a news story about a company, thousands of professional traders have already incorporated that information into prices. The implication, if you are trading based on public information, you are always behind the market. Your only reliable edge is time, holding broadly diversified positions through the market's long-term upward trend. The action? The next time you feel you have spotted a pattern in a stock chart or a market trend, pause. Ask yourself, if this pattern were predictably profitable, why hasn't it already been arbitraged away by the millions of professionals who track the same data? Chapter 2, The Firm Foundation Theory versus the Castle in the Air. Malkiel opens with two competing theories of how investors value stocks. The firm foundation theory argues that every stock has an intrinsic value based on the fundamental characteristics of the underlying business, its earnings, dividends, and growth prospects. The intelligent investor buys when the price is below intrinsic value and sells when it is above. This is Graham's approach, and it has genuine intellectual merit. The castle in the air theory argues that stock prices are determined not by intrinsic value, but by what investors expect other investors to believe in the future. Keynes described this as a beauty contest where the winner is not the person who picks the most beautiful face, but the person who best guesses what other contestants will consider most beautiful. Malkiel's view, both theories contain truth. In the long run, intrinsic value matters. Companies with strong fundamentals tend to outperform over decades. But in the short run, sentiment, narrative, and mass psychology drive prices in ways that have nothing to do with fundamentals. This duality explains why markets can remain irrational far longer than logical analysis would predict, and why bubbles can inflate to extraordinary levels before they collapse. The action: when evaluating any investment, ask both questions. What is the underlying business actually worth based on its fundamentals? And what are other investors currently believing? And why might that belief be fragile? Chapter 3. Technical Analysis. Why chart reading doesn't work. Technical analysis, the study of price charts, patterns, and momentum indicators to predict future price movements, is one of the oldest and most persistent practices in investing. Malkiel spends a full chapter demolishing it. His core argument: every pattern identified by technical analysts has been tested rigorously by academic researchers. None of them produce returns above what would be expected by chance once transaction costs are included. The head and shoulders pattern, the double bottom, resistance levels, moving average crossovers, these patterns look meaningful because the human brain is wired to find patterns, especially in noisy data. But the appearance of patterns does not mean the patterns have predictive power. Malkiel ran a fascinating experiment. He generated random stock charts using coin flips, heads for up, tails for down. When shown these charts without context, technical analysts identified the same patterns they find in real market data. They saw trends, reversals, and formations. All of it was random. This does not mean that momentum is completely meaningless. Some academic research suggests that short-term momentum, stocks that have outperformed recently continuing to outperform briefly, is a real effect, but it is small, inconsistent, and largely disappears after transaction costs. The action: if you use any form of technical analysis, research the academic literature on its predictive power. Look for peer-reviewed studies, not trading forums. The evidence may surprise you. Chapter 4. Fundamental Analysis. Better but still imperfect. Fundamental analysis, studying companies' financial statements, competitive positions, and growth prospects to identify undervalued stocks, has more credibility than technical analysis. It has produced genuine results for investors like Warren Buffett and Benjamin Graham. But Malkiel shows that it is also far less reliable than most practitioners believe. The problem is that the future is genuinely uncertain, and financial analysts consistently overestimate their ability to forecast it. Studies show that professional analysts' earnings forecasts are systematically wrong, not slightly wrong, but significantly wrong, year after year. The consensus forecast for any given company's earnings is typically no more accurate than a simple extrapolation of historical growth. Moreover, even when analysts correctly identify a company's strong future prospects, the market has often already incorporated those prospects into the price. A company that will grow earnings by 20% per year is already priced to reflect that growth. Only growth above the market's expectation produces above-market returns. Malkiel's conclusion: fundamental analysis is intellectually honest and sometimes produces insights, but the evidence that it reliably produces above-market returns after fees is weak. For most investors, it produces no advantage worth the cost and effort. The action: if you research individual stocks, review your portfolio's performance net of fees over the past 5 years. Compare it to a simple index fund. Be honest about what the comparison shows. Chapter 5. Modern Portfolio Theory. Diversification as the free lunch. Malkiel devotes substantial attention to modern portfolio theory, the mathematical framework developed by Harry Markowitz in the 1950s that showed how diversification reduces portfolio risk without necessarily reducing expected return. The key insight: different assets move differently. When some assets fall, others may rise or hold steady. A portfolio of assets with low correlation to each other will have lower overall volatility than any individual asset within it, without sacrificing return. Diversification is, in Markowitz's famous phrase, the only free lunch in investing. Malkiel extends this to asset classes. Stocks, bonds, real estate, commodities, and international assets each have different return and risk profiles that complement each other in a portfolio. The investor who holds all of these has lower risk than the investor who holds only one for the same expected return. The practical implication: concentration is almost always a mistake unless you have genuine inside knowledge of a specific business. The investor with 20% of their portfolio in a single stock has taken on enormous idiosyncratic risk specific to that company. that diversification could eliminate without cost. The action: review your portfolio for concentration. Does any single stock represent more than 5% of your total portfolio? Does any single sector represent more than 25%? If so, consider whether that concentration is justified by specific knowledge or simply by inertia. Chapter 6: The Efficient Market Hypothesis, What It Really Means. The efficient market hypothesis, the theoretical foundation of Malkiel's entire argument, is widely misunderstood, including by many of its critics. It does not say that markets are always right. They are demonstrably not. Bubbles happen, crashes happen. Individual stocks are sometimes massively overvalued or undervalued. What it says is that markets process available information quickly and efficiently enough that it is very difficult for any individual investor, using publicly available information, to consistently identify mispricings before the market corrects them. The market is not perfectly efficient, but it is efficient enough that the transaction costs of attempting to exploit inefficiencies typically exceed the gains. Malkiel distinguishes between weak form efficiency, semi-strong form efficiency, and strong form efficiency. He accepts that markets are approximately semi-strong efficient, meaning that public information is rapidly incorporated into prices, but that private information and genuine analytical insight can still produce excess returns in some circumstances. His practical conclusion: individual investors should accept market efficiency as the starting assumption. The burden of proof lies with anyone claiming they can consistently exploit inefficiencies, and the historical evidence shows that very few can do so after costs over long periods with statistical significance. The action: the next time you are tempted to make an active investment decision, ask, what do I know that the market doesn't? If the honest answer is nothing, the passive option is probably the right choice. Chapter 7: The Life Cycle Guide to Investing, a Practical Framework. Malkiel ends with practical advice. After demolishing most forms of active investment, he builds a simple framework for what investors should actually do. The core principles: invest regularly, diversify broadly, minimize costs, and match your risk exposure to your investment horizon and circumstances. For younger investors with long horizons, own primarily equities, a mix of domestic and international index funds. Time absorbs volatility. The long-term expected return of equities exceeds bonds and cash by a significant margin. For older investors approaching retirement, shift gradually toward bonds and income-generating assets. Reduce the exposure to equity volatility as the time horizon shortens and the ability to recover from large drawdowns decreases. In all cases, minimize fees, minimize trading, maximize tax efficiency, and resist the temptation to make strategic adjustments based on market conditions or economic forecasts. The forecasts are unreliable. The strategy should be stable. Malkiel's final thought: investing is not about being smart. The smartest person in the room does not reliably outperform the market. Investing is about being systematic, patient, and humble. Humble enough to accept that the market knows more than you do about what most assets are worth. The action: write down your investment strategy in full. Does it account for your age and horizon? Does it minimize costs? Is it simple enough to implement without constant attention? If not, simplify until it is. Key quotes. A blindfolded monkey throwing darts at a newspaper's financial pages could select a portfolio that would do just as well as one carefully selected by experts. The stock market is not a casino, but it can become one if investors ignore the fundamentals. Diversification is your buddy. The most important thing in investing is to realize how little you know. Buy and hold, the only sure path to long-run investment success. How to apply this. The core message of a random walk down Wall Street is actionable immediately. Begin with the first principle today. A note at the end. A Random Walk Down Wall Street by Burton Malkiel is a book that rewards rereading. Return to it whenever you feel financial anxiety, not because it will tell you what the market will do next, but because it will remind you what matters and what does not. This has been WealthWorks. If this was useful, subscribe. There is more where this came from. Ituriwing, Tawanavada